Welcome to Beavers Wealth Management's September 2025 edition of Let's Talk Markets. Our goal remains clear: to educate, inform, and empower the families and businesses we serve. And so, if you find today's discussion valuable, please feel free to share it with those who might benefit. As we sit here on September 10th, I feel it's important to pause and acknowledge what tomorrow represents. September 11th will always be a day of deep remembrance for our country. It's a time when we honor the lives that were lost, the families forever changed, and the courage of so many who stepped forward in the face of tragedy. For me, it's also a reminder of how quickly life can change and why the people we love and the plans we make for them matter so deeply. We carry that perspective into everything we do, so let us not forget. All right, in this edition, we'll highlight compelling data and research shaping today's markets, discuss the trajectory for the Federal Reserve rate cuts. We haven't talked about that in a while. And we're going to close with a few of the most interesting developments we've seen so far in 2025. All right, so let's get into it. So the proof is really in the pudding, right? And we've heard the classic market cliches. You want to buy low, you want to sell high, or time in the market beats timing the market. There are so many of these out there. And one of the most common, 7 out of 10 years the market finishes positive. Well, here's the data behind that saying. So this chart here actually tracks every single year of the S&P 500 since 1928. And so out of 97 years, 71 finished positive. So that's about 73%, or nearly 3 out of every 4 years. So in other words, the odds of historically have favored the patient investor. Now, the average annualized total return over that period has been about 10%, despite the sharp occasional downturns like what we saw in 1931 or 2008. But what makes the difference is that those tough years have been outweighed by the many years of steady or even strong gains. So the next time you hear that cliche, 7 out of 10 years are positive, there's usually hard data to support these sayings. And more importantly, it's a reminder that while turbulence, it's inevitable, long-term investors have historically been rewarded with growth that compounds decade over decade. All right, now let's take a look at where the market currently stands for the year. Give us some market facts. S&P for the year up about 11%, with the Dow about 8%. NASDAQ a little more than that, about 12%. Even though the S&P and NASDAQ really have been following each other very closely, and we'll get into more detail about that. Top level of the sector that has performed the best, communication services at 23%, industrial second at about 15%, and then tech leading the way at 14%. So basically those are the top three, and the bottom three, which is interesting, all are still positive, all positive for the year. This is the first month that we're seeing that. Energy finally up 3% for the year, and healthcare even up 1%. Now, Fed funds rate stays at 4.5%. CPI, or the inflation data that we've seen, at about 3.1%. So that is kind of hovering right around that 3, and we haven't seen it go below 3 in a long time. Unemployment ticked up a bit, 4.3%, and GDP a little higher than expected at 3.3%. All right, now one of my favorite parts of Let's Talk Markets, of course, are Ryan's market fact, and what he titled this market fact, "The Heavyweights Dominate." So let's talk about concentration in the S&P 500. Right, I just got done saying S&P 500 and the NASDAQ have been feeling a lot similar, right? They've been moving in the same way, it seems like, every day. And today, just 5 companies, NVIDIA, Microsoft, Apple, Amazon, and Google, make up nearly 30% of the index. That's the highest level of concentration we've seen in over 60 years. Those 5 stocks. Here's one way to think about it. The S&P 500, it includes over 500 companies, right? The S&P 500. But roughly 1% of those names account for nearly a third of the entire index. In other words, when the S&P 500 moves, much of the story boils down to how those 5 big names perform. So let's take a look back at this chart. This isn't entirely new, right? In the 1970s, we actually saw what they called the Nifty 50 lead the market. The dot-com era and the late 1990s had a similar trend. Each period had different drivers, but the pattern, it was consistent. Outsized influence from a small group. This is a reminder that broad diversification, it may not be as broad as it sounds. It may surprise many, but investing solely in an index fund means your returns are heavily tied to these mega cap stocks. And that's a dynamic that's worth keeping in mind, because even though the S&P 500 includes hundreds of companies, just a handful may carry the weight. So, great market fact for today. But let's get to the meat of Let's Talk Markets. And really what I want to talk about is the Federal Reserve rate cut, because that's been a lot of discussion that we're hearing. And I really want to know, okay, why does this matter, right? When you're, as an investor, you're looking at this, why are the federal funds rate cuts so important? And interest rates, they are one of the biggest forces shaping the markets right now. And that's been the case throughout history. So if you remember on Let's Talk Markets, previous Let's Talk Markets, we've often say there are 2 big drivers of long-term market growth. Can you remember what they are? Number 1, corporate earnings. Can companies continue to grow their balance sheets and become more valuable? And number 2, interest rates. The undercurrent that influences everything from stocks and bonds to housing and even business investment. Now, here on Let's Talk Markets, you can go back to some of our previous editions where we've talked at length about interest rates and our expectations. And when the Fed began cutting rates, we believed they would postpone those cuts for as long as possible and that rates would remain higher for longer. At the start of 2025, markets were pricing in 4 to 6 rate cuts by year end. We expected fewer. Go back to our previous Let's Talk Markets in January and February, and you can see we didn't believe what the market was saying at that particular time. Today, consensus has shifted to align more closely now with our initial view. The market is now looking for just 2 cuts this year. One in September and another in December, each at 25 basis points, which would bring the federal funds rate down to around 3.75% to 4% by year end. So naturally, if we expect cuts here at the end of this year and going into 2026, that raises the question, historically, what happens to bonds and the broader market during Fed cutting cycles? Well, I'm glad you asked. Let's take a look at it. Bonds and cutting cycles. Let's look here first. History shows they've generally performed well when the Fed is in an easing policy. You can see here in the 1989-1992 cycle, the Bloomberg U.S. Aggregate Bond Index returned nearly 12% annualized. All right, well then what about the 2001-2003 cycle? Bonds gained just over 9% annualized. Even more recent cycles like 07-08 and 2019 produced positive returns in fixed income. On average, though, bonds returned about 5.7% annualized during Fed cutting cycles. This consistency kind of highlights how lower rates often create a tailwind for fixed income markets. Now, let's look at all asset classes after a first cut by the Fed. Let's zoom out. You look across all major asset classes after the first Fed cut, and what do you see? The S&P 500 averaged about 7% returns in the first year, climbing to 23% after 2 years, and nearly 30% after 3 years. Core bonds continued to show steady mid-single-digit performance, which is expected. High-yield munis and other short-term treasuries added incremental gains as well. And so really the key takeaway here is that both stocks and bonds have historically found support in the years following the Fed's first rate cut. And the effect compounds as time goes on. So you're asking yourself, why does this matter to me? Because Fed policy sets the tone for the entire market environment. History suggests that both equities and fixed income have tended to benefit once cutting cycles begin, making interest rates a theme every investor should keep front and center as we move into the back half of 2025. Okay, now we're going to talk a little bit about what's new, what's next for the markets. So when we think about the market, it's not just numbers on a screen, it's also the stories behind the companies shaping tomorrow, right? Innovation is happening everywhere we see it. It's incredible. And these shifts, they often ripple into the markets in surprising ways. So this month, we wanted to talk about 5 major innovations kind of caught our attention, right? There are countless examples out there, but these 5 kind of stood out to us as particularly interesting and worth watching. So let's go. Number 1, GE Aerospace, hybrid propulsion for the next generation of aircraft. So GE Aerospace is taking flight in a completely new direction. The company announced a $300 million investment with Beta Technologies to develop hybrid electric turbo generators. So what does that actually mean in plain English? Instead of relying purely on traditional jet engines, these new systems combine electric and fuel power to make aircraft more efficient and sustainable. For both military and civilian use, this is a big step toward the aviation industry's long-term goal, distributed electric propulsion. Think cleaner skies, lower fuel costs, and a whole new era of aircraft design. Pretty cool. All right, number 2, Apple. We've talked a little bit about this, but they are investing $500 billion into US chips here domestically. They're doubling down on building technology here at home in the US. So earlier this year, the company announced a massive $500 billion commitment to US chip manufacturing, R&D, and other advanced production facilities. So that's one of the largest corporate investments in American history. Beyond jobs and economic impact, it's a play for supply chain security and independence in semiconductors, which are the building blocks of everything from iPhones to cars to all of it. With geopolitical tensions that are so high, Apple's move shows how critical it is to making the future of chip making. So they've got to control that future, and that's one of the things that they're spending a significant investment on. So that's number 2. Number 3, I like this one. Even though I'm more of a Coca-Cola guy, right? Diet Coke is my thing, but we're going to talk about PepsiCo. Functional drinks are going mainstream. I didn't know this, but you might not think of Pepsi as kind of an innovator, but the company is kind of leaning into the wellness trend in a big way. So in 2025, PepsiCo launched a new probiotic and prebiotic cola that has 30 calories, no artificial sweeteners, and 3 grams of fiber? On top of that, they actually acquired Poppy for almost $2 billion. It was $1.95 billion, a brand that's been riding the wave of what we call functional sodas. Now, this isn't just about selling more drinks. It's about capturing a shift in consumer demand for beverages that do more than just taste good. For Pepsi, it's a strategic move to stay relevant with the next generation of health-conscious buyers. I'm still sticking to my Diet Coke, though. All right, number 4, Constellation Energy. Nuclear power contracts, clean energy got a huge boost this year from Constellation Energy, the company. It secured an $840 million 10-year contract with the U.S. government to provide nuclear-generated power to key federal agencies, including the Federal Reserve and the Social Security Administration. They also struck a deal with Microsoft to restart and supply power from a nuclear reactor at 3 Mile Island. Nuclear often gets left out of the renewable conversation, but it's one of the most reliable, carbon-free power sources that we have. And these deals put Constellation at the center of Americans' clean energy transition. All right, and finally, CoinBase. Crypto just joined the S&P 500, a milestone for digital assets, but Coinbase has now officially added the company to the S&P 500 this year. And it makes it the first ever cryptocurrency exchange included in the index. It actually replaced Discover. For years, crypto has lived on the fringes of finance, but this marks a turning point. Being a part of the S&P 500 puts Coinbase shoulder to shoulder with America's most established companies. Now, it doesn't make crypto risk-free, as we know, but it does signal that digital assets have secured a seat at the table in mainstream markets. Man, so from hybrid propulsion in aerospace to Apple's $500 billion bet on chips to functional sodas, clean nuclear power, and crypto going mainstream, innovation is alive and well across so many industries. The market is constantly evolving in ways that touch everything from the planes we fly to the phones we carry to the drinks in our fridge. Now, as we just discussed, markets are constantly changing. And over the past year, that's meant not just innovation, but also plenty of volatility. And volatility often creates opportunity. So if you have a friend, family member, or colleague who could benefit from a trusted second set of eyes on their portfolio, we encourage you to share our second opinion service. As I've said before, it's a complimentary review that we can help ensure investments are aligned, risk is balanced, and opportunities aren't being overlooked. Because we've seen firsthand how valuable this can be, especially in uncertain markets. So if someone you know might benefit, invite them to tune in to our Let's Talk Markets podcast here, or to connect with us directly at any time. We'd be honored to help. Man, a lot of stuff that we covered today. And as I said, we truly are so grateful that you joined us. And we encourage you to share this content with anyone who might find it valuable. And all of the replays of Let's Talk Markets, they're posted on our YouTube channel. And if you haven't checked it out yet, you should, as it's also home to our Beaver Nuggets and our podcast, Between the Bears and the Bulls. And believe it or not, we actually officially hit the 1-year mark for Between the Bears and the Bulls. And we're excited to keep sharing interesting stories of businesses, markets, life, and everything in between. That's what Between the Bears and the Bulls is all about. Now, as always, if you have any suggestions on what you'd like to see from us, always let us know. I love the input, I love the feedback, and we get it from many of you who join Let's Talk Markets on a consistent basis. So thank you for that. We continue to put out and hope to continue to put out valuable information to you based on that feedback. Oh, okay, and one last interesting bonus fact, just before you go. Did you hear about the person who invented the knock-knock joke? They won the Nobel Prize. We'll see you next month for October's edition of Let's Talk Markets. Hey, and don't forget, leave it to Beavers.